Welcome to the first lesson. This is Unit 1, Lesson 1, and I'm going to be going through some just general background information, general definitions, governing organizations, and things like that. And basically, I just need to get this information out of the way. It's not the most exciting information. It's basically just to give you a background about accounting and the career of accounting. And you basically just are being set up for the rest of this series where some of these things are going to come up again and again. And then, of course, if you're going to work in that accounting field, you should at least be familiar with some of the main principles and governing organizations and things like that. It just makes things a little easier for you as an accountant to know these things. So basically, the first thing that I want to do is give you a definition of accounting. Accounting is the language of business, and it's going to be stated, all of the accounting is going to be in monetary terms. So in other words, you're dealing with the company's money. So you're measuring the business activity in monetary terms. You're making that activity or that data into reports, preparing reports from that data, and then those reports are used to communicate the information to the decision makers of the company. So you are, and you'll have to forgive me, it's been several years since I've taught a lot of this stuff in a classroom, so I do have to look at notes sometimes. And I think I need a different marker. And something that's really important for me to point out is if your accounting is incorrect, then your reports would be incorrect, and the decision makers are going to use the incorrect information to make their decisions. So it's really important to get the accounting correct if you are in the accounting field. And there's two main fields of accounting. There's financial accounting and managerial accounting. This class, this series is going to be more focused on financial accounting. Hopefully, after I'm done with this series, I can make a managerial accounting series. But for now, we're going to learn the basics, learn the main accounting that you will see, and then we will get into managerial accounting at some point. If you're taking accounting as a class at a college, you're going to probably learn financial accounting in 1 or 2 classes, and then managerial accounting would be a separate class. Financial accounting is more focused on external users, in other words, providing information to people outside of the company, such as creditors who may loan the business money. They're going to want to see that company's financial reports before they loan them money. Taxing authorities are going to want to know what expenses, what revenues that business had to basically make sure they're paying the correct amount of taxes. And investors, if it's a publicly traded company, in other words, they sell stock on the stock exchange, they're going to want to make sure they're investing in a good company that has good financials. So financial accounting is focused more on making sure the data is correct, the accounting follows certain rules, and that accounting is then used to give that information out to whoever's making a decision about that company. And then managerial accounting is more internal accounting. It's more focused on providing people inside the company the information they need to make decisions. So this would be information for the owners, the managers, anybody that's making a decision inside that company. And this is going to be more detailed accounting. This is going to be more follow guidelines, do the accounting in a certain way so that everybody's accounting is basically the same. And then over here in managerial accounting, this is more going in depth. There's not some set rule book, although you should probably learn the managerial accounting techniques, and then you use those techniques to basically work with the data and make decisions from that. Financial accounting is looking at things that have already happened in the past and recording that information in their accounting system and preparing reports that people outside of the company may use to make a decision about that company. Whereas managerial accounting, you're looking at things like forecasting, budgeting for the future, deciding whether to drop a product line, deciding what prices you should charge for your products, and it just gets into a lot more detail internally. So that's going to be more forecasting, budgeting, and things like that. So that's just the difference. And most companies have both of these things going on at the same time. They have their financial accounting, they're inputting their data, they're preparing reports, but then at the same time, they're probably looking at that data and using it and doing some extra calculations to make some decisions about maybe projections, products, pricing, things like that. So they're going on at the same time. And it's just easier to learn both of these separately in a separate class. That's why I said I'm going to teach the financial accounting, and then you would probably learn managerial accounting later on once you have the main principles correct. Financial accounting is going to follow something called GAAP, which is the main accounting rule book in the US. Different countries are going to have different rule books. So GAAP, GAAP, stands for Generally Accepted Accounting Principles. And we're going to talk more about it in just a few minutes. Okay, hopefully you don't have any questions at this point. I'm going to erase this and move on to the next topic. Another thing that you should at least be familiar with in order to learn accounting is some of the governing organizations that are involved. First of all, there's some organization called the FASB, or Financial Accounting Standards Board. And this is a private organization that basically formulates the accounting guidelines, GAAP. So they are privately funded. And they formulate accounting standards, which they basically make the rules. They make the guidelines that are generally accepted accounting principles, or GAAP. Okay, and then another organization that you will hear about is the SEC, which is the Securities and Exchange Commission. So the Securities and Exchange Commission oversees the financial markets. So if a company is publicly traded, meaning they have stock that they sell on a public stock exchange, then they're going to need to follow the guidelines of the SEC. So these are going to be some extra guidelines that the company is going to need to follow. One of those guidelines is the company has to follow GAAP. They have to follow generally accepted accounting principles. So they oversee the publicly traded companies. And this is a governmental agency in the US. And they oversee the FASB, the Financial Accounting Standards Board. And one of their rules is that any companies that are publicly traded has to follow GAAP. And then you have generally accepted accounting principles, or GAAP. And as I said earlier, this is basically the US rule book, US accounting rule book. These are the accounting guidelines. And by everyone following the same rules, it ensures consistency. So if you're thinking of investing in companies, you can know that they're following these same principles, so you can compare a little more easily if you know they're all kind of doing their accounting in the same way. So it does help with consistency. And then some other standards that may need to be followed if a company is global is the international standards. So these are rules for global companies. And at some point, it was thought that the international standards would kind of eventually kind of merge with the US standards, and US would be following international standards. They're very similar standards. There's just a few differences, but that has not come about. They're still two separate sets of standards. And if a company is doing business globally, then they may have to follow these international standards, just depending on their situation. So there are some international standards, and then of course companies have business in certain countries and may have to follow that country's guidelines. So it just varies depending on where that company is doing business. But it's just something to pay attention to if the business is doing commerce globally. Now I'm going to talk a little bit about some accounting careers. I'm actually not going to write this on the board. I just want you to know that there are a lot of different areas you can go into in accounting. Actually, I'm going to write a couple on the board. Okay, so as far as careers in accounting, there are a lot of different areas you can go into if you're going to be an accountant. I know when I talk about being in the accounting field, people automatically assume that I do tax, but I don't. So there's just a lot of different areas. You can be a tax accountant, you can do management accounting or cost accounting, you can be a bookkeeper, you can be a payroll clerk or just work in payroll. So there's just a lot of different areas of accounting that you can work in. It is a good field. There are opportunities to work from home, which is kind of helpful. I've worked from home since 2016, and that to me is great. It's, to me, it's a good career. It's not something where you have to be in meetings all day or be on the phone all day. You're basically just getting the work done, and that's it for the most part, just depending, of course, what company you work for and what kind of work you do. But the point is there's a lot of different areas of accounting that you could work in. And just a couple of designations that you could get if you wanted to get some certifications. You could be a certified public accountant, which is a CPA. So a certified public accountant is certified to work for the general public. This is something in the United States. So it's a certification and serves mostly the general public. And a lot of times they do taxes and audits and things like that, but it just depends. They can also do bookkeeping. It just depends on that accountant and what they want to do with it. But this is a designation that they could get. And you would need to check with your state to see what the requirements are to be a CPA in your state or get the certification. There's also something called a certified management accountant. And again, you would have to look up the requirements for this, but this is just another certification you could get, excuse me, especially if you're working for mainly one company and not several companies, where a CPA a lot of times is more likely to be working for multiple companies and doing their taxes or doing their audits or things like that. Of course, you know, it's going to depend, but this is more doing the management or internal accounting in a company. So that is a certification you can get as well. You could also become a certified financial planner. So that's a certification. And then in other countries, there's something called a chartered accountant. In some other countries, it's more popular, or I see it more. So that is another designation you can get as well. So you don't need to get the certifications to work in the accounting field. These are just some options for you. And of course, there are others as well that you could look into. Okay, and then there are some principles that you should be familiar with, some concepts that you're going to see again throughout the lessons, throughout your accounting class. So I just want to briefly go over them, and then I'll mention them again later on throughout the lessons. So the first one that you're going to see probably the most in several lessons is the historical cost principle, or the cost principle. And all this is it says that you record your assets on the books at cost. In other words, what you paid for them. You're not putting it on the books for the value, the market value, what you could buy it for now. And that's just because that would be too difficult, because the value changes over time. If you purchase some equipment, the value of that equipment is going to change over time. So it's just too much work. There's just too many variables to try to figure out what the market value is. So you would record assets at the cost, what was paid for the asset at that time that it was purchased, and that's it. So keep it simple. So you will see this one again multiple times. And then this is just because it's also a reliable measure. You can rely on how much it cost. And then something else that's really important is something called the economic entity concept. And basically, this is just stating that the business is a separate entity from its owners. In other words, the business is going to keep their business financials separate from the owners. It's a separate entity. You want to track your accounting separately. So you really want to try to have separate bank accounts if possible, and separate accounting for personal versus business. And then the going concern concept or assumption. This is just stating that you would do your accounting as if the company is going to be in business for the foreseeable future. So you're assuming the business will be in operation for the foreseeable future. But that's all it is. In other words, you're assuming that the business is going to be in business for you to do your accounting, at least while those assets are being used. So you're just basically doing your accounting. You wouldn't say, well, I'm not going to be in business next year, so I'm only going to depreciate this for 1 year. You don't want to do that. You basically would do your accounting as if it's going to be in operation continuously. And then the faithful representation principle. All this is saying that your accounting should be complete, neutral, and free from error. So these are just some of the guidelines that companies should be following as they do their accounting. And then the last part of this lesson is going to be talking about some ethics in accounting. First of all, if you're investing in companies on the stock exchange, if you're loaning a company money or something like that, you want to be assured that you are putting your money into some company that has accurate financials and there's not any fraud or embezzlement or anything like that going on. So there are some extra protections in place for those types of situations. First of all, companies that are publicly traded have to have something called an audit. An audit is simply an examination of the company's financial records. So an independent accountant would go in and they would audit the records, they would review it, they would probably take some samples, look at some transactions, and really dig into what that company is doing in their accounting system. And that auditor, the independent accountant, would give an opinion on whether those financial reports, financial statements, are in accordance with the guidelines. And if you're thinking of investing in a company, you can probably find the auditor's report and read that report on what the auditor said about the company's financial records. So audits, something that public companies have to do. For private companies that are not publicly traded, they may or may not have to do an audit, just depending on what requirements they may have for different situations. For example, they may want to get a loan and that bank requires them to have some sort of review, maybe not a full audit, but a review or an audit of their financial records. So private companies can deal with audits as well. And then some companies have a private internal auditor that basically oversees things within the company. So that can happen as well, just depending on the company and how big they are. It just depends. But basically an audit is just digging into the financial records. And then I can't remember what year it was. I think it was around 2008. There were some scandals where an independent auditor was supposed to be auditing financial records of some companies, Enron and WorldCom, and there was a lot of fraud going on. And I don't remember all the details, but basically some extra protections were put in place after those scandals. Something called the Sarbanes-Oxley Act was put in place. And this basically just requires management to review internal controls. And take some responsibility for the accuracy of the information. For the financial information, that is. And it also made it a criminal offense to falsify financial records. So these, like I said, these are just some extra protections that were put in place to protect investors. So I'm glad you got through all of that. Thank you so much for watching, and I look forward to teaching you this series.